Welcome back to our series on crypto investing. Today, we're diving into one of the most important, yet least understood concepts in the entire space: token velocity. Have you ever wondered why some tokens with massive daily usage, just go yin, seem to hold their value? Their prices just keep falling, even when the network is buzzing with activity. The answer, in many cases, is token velocity. The tokens are simply moving too fast. In this video, you'll learn exactly what token velocity is, why it's a critical metric for any serious investor, and how it can silently drain the long-term value from a project. So, what is token velocity? It's a measure of how quickly a token changes hands. Think of it like this. High velocity means people get the token and spend it almost immediately. Low velocity means people are holding on to it for longer periods. And for an investor, this single metric can be more revealing than hype, marketing, or even the stated utility of a token. Let's break down why that is. Imagine a token that's designed to be earned, used for a service, and then immediately sold on an exchange. The token comes into a user's wallet, and then it goes right back out. In this high-velocity loop, real demand never gets a chance to build up. Even with millions of transactions, the price struggles to climb because there's a constant, never-ending stream of tokens hitting the market. The selling pressure is relentless. The system indirectly discourages holding, turning the token into a temporary voucher instead of a long-term store of value. This is the silent killer of many crypto projects. Let's use a simple real-world analogy to make this crystal clear. Think about your personal finances. If you earn a paycheck and spend every single dollar the moment you get it, you never build any savings or wealth. Your money has high velocity, but your net worth stays flat. The exact same logic applies to crypto tokens. A token's price grows when people want to hold it, which pulls supply off the market. When demand then increases for a smaller pool of available tokens, the price naturally goes up. Holding creates scarcity and upward price pressure. High velocity releases that pressure, constantly pushing the price back down. This brings us to a huge misunderstanding in crypto. The difference between velocity and utility. Many projects will tell you, the more our token is used, the more valuable it will become. They point to rising transaction counts as a sign of success. But this is a dangerous oversimplification. You have to ask a much deeper question. Does the utility of the token encourage holding, or does it require selling? If the main use case is to pay a fee and then immediately sell the token, then more utility actually leads to higher velocity. And as we've learned, higher velocity can suppress the price. A project with 1 million daily transactions can still have a token price that goes to zero if nobody has a reason to hold it. This is why good tokenomics is fundamentally about controlling velocity. The best projects build in mechanisms to slow it down. They want to encourage long-term alignment between the token holders and the health of the network. How do they do this? Through things like staking rewards, where you earn passive income for locking up your tokens, or through lockup periods for early investors and team members, preventing them from dumping on the market. They might also offer governance rights, giving holders a say in the future of the project, which is a powerful incentive to stick around. These systems create a healthy balance. The goal isn't to stop people from ever using the token. That would kill the network. The goal is to find that sweet spot. Too much velocity, and the price collapses. Too little velocity, and nobody uses the platform. Token velocity also changes dramatically depending on the market cycle. During a bull market, everything speeds up. Hype and speculation take over. People are trading frequently, jumping from one hot project to the next. Velocity naturally increases across the board. But the real test comes during a bear market. This is when velocity slows to a crawl, and this is when projects with weak tokenomics get exposed. If nobody has a reason to hold a token when the hype dies down, its price will collapse. But the projects with strong holding incentives, the ones that truly reward their long-term supporters, are the ones that tend to survive and thrive when the market recovers. If you understand velocity, you can see these cycles coming and position yourself accordingly. So, what are some red flags you should look for? Be very cautious if a project's rewards are designed to be instantly sold. For example, if you earn a token for playing a game, but the only thing you can do with it is sell it on an exchange. That's a high-velocity design. Be wary if the core utility requires constant selling, or if there are absolutely no incentives to hold for the long term. And watch out for high inflation that constantly floods the market with new tokens, diluting everyone's share. These are all signs of a system designed for short-term extraction, not sustainable growth. As a long-term investor, you want to find the opposite. You're looking for projects where holding is actively rewarded, where the token supply is either fixed or decreases over time through mechanisms like token burns, and where demand for the token is growing organically because the project itself is valuable. A common mistake for beginners is to get fixated on metrics like daily active users, transaction counts, or trading volume. But as you now know, volume without holding doesn't create lasting value. Token velocity is the missing piece of the puzzle that explains why. By understanding this concept, you can avoid tokens that are built to be spent and instead focus on tokens that are built to be held. ULLs start to see the hidden architecture behind a project's economic design and make much smarter investment decisions. In our next video, we're going to take this theory and apply it to one of the most complex areas of crypto. We'll explore why so many DeFi tokens have underperformed, how liquidity, mining, and yield farming affect token velocity, and what to look for in a sustainable DeFi project. If you found this explanation helpful, make sure to subscribe so you don't miss part 9. Thanks for watching, and I'll see you in the next one.